bit of a mixed picture throughout the year. At the first part of the year, the People's Bank of China was a big buyer of gold, but we've seen other central banks as well participate. So in Q3, for example, Poland, Hungary, the Reserve Bank of India were all buyers of gold. Now, we produce an annual survey of central banks, and that was published in July 2024. And actually what that was pointing to was continued interest from central banks. So 81% of central banks that responded to our survey suggested that gold was going to play a bigger role in their reserve portfolio management going forward. So there's sustained interest, and there's interest from central banks for a number of reasons. Gold is a physical asset. It's nobody else's liability, so it's considered a safe haven. But it's also a very liquid asset. So over $165 billion of gold is traded every single day, and it can mitigate risk. So historically, it hasn't been that strongly correlated with other asset classes, and that lack of correlation means that it can be an effective portfolio diversifier. Mm-hmm. So all of those things together, plus the positive performance of gold historically, has led central banks and other institutional investors to be interested in gold.
We want to shift for the tension and the geopolitical factors. Do you see the geopolitical factors are the main factors that are moving the prices at 2024 and the purchases for sure? And what do you expect for 2025?
Look, geopolitics is one element of gold demand. It's certainly one of the reasons why individuals or institutions allocate to gold. And that's because, as I mentioned, gold can be an effective diversifier, and it's a physical asset, so it's seen as a safe haven. But when you look at the figures, if you look at the Geopolitical Risk Index, for example, which is an international index of geopolitical risk, when that is up by 100 basis points, gold historically has gone up by about 2.5%. So there is a relationship between geopolitical risk and gold's performance, but it's not the only reason for investing in gold. As I mentioned, the other reasons like its liquidity, its performance over time, historically, its role as a diversifier, these are all other factors that drive investment interest in gold. Geopolitics is just one of them, but certainly when we've seen heightened geopolitical risk events, gold has historically been supported by that.
And in 2025, we are going to see Trump as the president of the US. How do you see the tariffs and the tension would affect the prices for the gold or the demand?
Well, I think a lot of people are expecting the new regime to be fairly inflationary. Certainly tariffs, that will be inflationary, and other measures as well. And gold is seen as a hedge against inflation. So when inflation is high, so above about 3%, historically gold has grown by about 13%. That's historically. So gold is considered a hedge against inflation, and many analysts are expecting the new regime to be quite inflationary. One thing I would say, though, is in the immediate aftermath of the US election results in November 2024, gold actually dropped. And that was because of a number of factors. One, a lot of the trades in the run-up to the election were in anticipation of an uncertain electoral outcome. And with hindsight, the electoral outcome was pretty clear. So we didn't have that uncertainty. So a lot of those trades were unwound. The second factor is about crypto. Yeah. A lot of people are expecting the new Trump administration to be more favorable to crypto and perhaps settle the regulatory debate around crypto. And that had a bit of an impact on gold. But I think that that's perhaps unwarranted, because gold and crypto assets, they're very, very different. They serve very different purposes in a portfolio. And the reason for that is, as I mentioned, gold is physical, but it's also, if you look at demand for gold, it comes from tech, it comes from jewelry, it comes from central banks, and it comes from commercial and individual investment interest in gold. Crypto, very, very different asset. It's mainly speculative, more investment focused, and therefore it has higher correlations with things like the equity markets, whereas gold doesn't. It has less correlation. So actually, if you're thinking about an allocation to crypto, that's not without risk, and to mitigate some of that risk, you could allocate to gold. So in some ways, they're actually quite complementary assets.
Okay, and lastly, the Federal Reserve will keep cutting the rates at 2025. What do you expect from the prices for the gold or the demand for the gold? Is it going to shift more people to purchase gold, or what exactly what we are expecting from gold at 2025 with the Fed cuts?
Historically, interest rate cuts have been supportive of gold demand, and that's primarily because interest rates are seen as an opportunity cost. When you can get higher yields, there's an opportunity cost associated with gold, which doesn't generate a yield. You're relying on the capital appreciation only. And so in a lower interest environment, that historically has supported demand for gold. And we saw that this year in September, when we saw lots of renewed interest from North American investors in particular, and that was as a result of the Fed interest rate cuts. We saw it in Europe as well, when the ECB started cutting interest rates a couple of months before the US. That supported investment interest in gold in Europe. And one indicator of this is what happens in the physical gold ETF space. Yeah. Physical gold ETFs, they're a small component of gold demand, about 2-3% of gold demand, but they're actually a big indicator of what institutional investors are thinking and what motivates them. And what we've seen in reaction to interest rate cuts is renewed inflows into ETFs. So for many years, for about 2-3 years, we've seen outflows from global ETFs. This year, in the last few months, or in 2024, in the last few months of 2024, we saw inflows into ETFs for the first time in quite a few years. And a lot of that was because of investors based in Europe and in the US reacting to interest rate cuts.